Today, I'm going to fill my stocks with around 2,000, maybe even 3,000 pounds. And I'm gonna do that for you and show you why I'm investing in the stocks that I am. But it's a nice day first, and I've got to go pick something up from somewhere. Ooh, new mail. By the way, that's the address if you want to send me some free stuff. It's not my home address, someone else's. Oh yes, new lens day. Nice and wide, looking good. So I knew what that one was, but I don't know what this one is. Riverside? Oh, it's like a phone selfie holder thing. It's come from Riverside.fm. Pretty cool. Thank you, Riverside. Oh yeah, look at that. So much better. So much wider. Right, first things first. So I have around, let's take a look, £2,877 to go into my investments right now. The first thing I do every single time I put new money into these investments is I put 5% of it straight into the S&P 500. I just do that. It's to make sure that I put enough money into the S&P 500 so I can track my progress against it. I also don't think it's a bad idea to just put it into a broad-based index fund, so I'm happy for the money to go in there. Today, that's £144, review order, send buy order, and hopefully that's gonna buy if the market's open. It is, market's still open, good. If we look at my pies, I'm currently sitting on my income pie at 13.5% in gains and 17.57 up on the S&P 500, which means I am losing to the S&P 500 right now. Total value, I'm not. I think I'm around 19% up, but the current unrealized gains losses that I'm seeing right now is all because of Russia. Russia's Norilsk nickel is a right pain in my ass. It's dropped my income pie value down by a ridiculous amount, and it's going to be very, very hard to recover from that if Russia don't sort their act out sometime pretty soon. Ugh, let's get home. Oh, that is wide. That's really wide. Pretty cool though. Maybe we'll keep it like this for a bit. Gotta be super close. Let's just chop that in a bit. So currently my portfolio stands at 44,470 and I have about £2,733 to bosh right in there. I think in my income pie I have £36 in cash. So let's just do a straight up invest right into there and bring it over the £50 threshold. So we'll put in 50 quid in there. Oh geez, you need a minimum of 200 now to invest into a pie. Oh, that's harsh. That must take ages for dividends to get reinvested. Oh well, let's bash in 200 then. And I'll put that money in straight by the targets. Let's see what it does with Norilsk nickel. And 3M, not too happy about that, but it is only £2.36 going straight in. So that's confirmed, and because the UK market's closed, it's going to take a while for that to go in. So that is going to set up as £146.68 that's blocked until tomorrow morning, basically. So I have 2,533 left to invest, and I am going to be putting the first bit into Lennar because it's dropped 3.5% today. And I think that is well out of order. Now, Lennar Corp is a US home builder and brand new home builder as well. Just from having a look at their website, you can see how similar they are to the UK new build home builders. Lots of bright and flashy images and lots of really homey style properties that are really on trend right now. Lennar is dropping in price right now because of those raised interest rates. The theory is interest rates rise, mortgages get more expensive, no one wants to buy mortgages, therefore Lennar is going to do terribly over the next 10 years. You also have the added problem of costs of materials going up, causing a lot of problems on the margin. This then leads to houses becoming too expensive with no one wanting to buy mortgages, and everyone's going to start renting again. I personally disagree with the market on this, and that's a big thing for me to say, but I still believe that Lennar and other US house builders have real pricing power. Pricing power is when customers want your product so much that they're willing to pay anything for it. It can also be that your product is so scarce right now that you can literally put any price on it that you want. Oil companies do this all the time. They shut down the production of oil, therefore creating less oil, which makes oil more expensive. But Lennar and other US home builders are in their own organic version of this. For years now, there's been a US housing shortage, and that does not look like it's going to come to an end anytime soon. And after the last 2 years, people now want the security and safety of owning their own home. And according to Lennar themselves, they haven't seen anyone jumping ship and going to renting.
It all seems to me to be a zero-sum game. If you look at both rental properties on the multifamily side, rental properties on the single-family side, and for sale properties where primary buyers are actually buying, all of them are fully occupied or just multifamily tenants. And across the board, you're seeing pretty aggressive escalation in prices because demand is strong and supply is constrained.
This combination of rent prices going up at the same time as housing leads me to believe that Lennar is still going to make the same amount of cash flows it needs to over the next 10 years. Lennar is set to benefit quite heavily from this housing shortage. There's going to be better grants, there's going to be easier planning permissions, and the only real constraint that we can see right now is that material costs are going to be quite high. And if Lennar makes it back to its 10 times multiple in the next 10 years, we're looking at a 37% annual rate of return. And if the price to free cash flow remains at a 6 in 5 years, we're still making a 6.95% annual rate of return. I like the odds on this one. I like that there's severe pricing power, and I like that there's a lot of demand for their product. Do not doubt it though, Lennar does lack a moat. There are lots of companies which are out for the competition here. Lennar, D.R. Horton, they seem to be the two best ones at the top here. So with that in mind, today I'm looking at buying 3 more shares of Lennar Corp. Next, Alphabet or Google. Google has recently made an acquisition of a company called Mandiant, which is a cybersecurity company. I'm just going to take this off because it makes a lot of noise. Now on its own, this company is largely a nothing company. But within Google's cloud system, we start to see serious uses and serious selling points for Mandiant when used in comparison to AWS and Microsoft's Azure. The company Mandiant itself is not going to be sold as any single product, but when you merge it with all the rest of the products, Google is now becoming a much more of an operating and enterprise service. You can really see now how it's attempting to eat a little bit into Microsoft's lunch. I use Google Docs and Google Sheets now. I definitely won't be paying for a Microsoft subscription after how good that is. I'm really keen now to see how Google is going to implement itself into businesses like how Microsoft and Amazon have. I foresee some sort of website builder, maybe an acquisition there of a Wix or Squarespace. I think that will really drive home their business and software as a service platform. Valuation wise, I think Google is undervalued, like many of the FANG stocks right now. We have a fixation right now on the Schiller PE ratio being so brutally high. But the truth is, many of the stocks like Facebook and Google are following their earnings. They're earning such a ridiculous amount that we can kind of accept price to free cash flows of around 20, 25, and we should still be okay. Of course, severe drops in valuation could lead us to underperform the market, but there's no reason I can foresee why the market would need to punish Google so much on its own. Obviously, during a systemic market crash, everything's going to fall. I'm also given confidence because Terry Smith, the manager of the Fundsmith Fund, in case you didn't know, the Fundsmith Fund has outperformed the market for like 10 years now. What a good looking man that dude is. And this guy generally doesn't buy tech stock. They've done very well on Amazon, PayPal, and Microsoft, but the majority of their gains over the past 2 years have been from Philip Morris, Church & Dwight, and McCormick & Co. It must be mad, everyone piling into all these speculative tech stocks, and Terry Smith is there beating the market with toothpaste. So I'm really behind Google now. I own a lot of products. It's a little bit heavy in my pie. I've given it a 10% weight and I really shouldn't buy anymore, but the price of it is dropping. It's still technically, to me, undervalued. I think I still want to put in a little bit more. So while it doesn't really move the needle much, I'm still going to add 500 quid to it and let it ride. One company that I've neglected for a long time is Store Capital. I stopped buying it for a while because the price started to get away from me a little bit, but also because Store Capital is an inherently riskier business. Most of those big famous REITs like Realty Income, Agree Realty, and Prologis all have investment grade clients. Store Capital is a little bit different and therefore a little bit riskier. It's still triple net lease. If you're going to go into REITs and you don't really know what you're doing, like me, then triple net lease REITs are probably the best way to go. It's very easy to understand. Your REIT collects the rent and the other company pays for everything else. It makes it very easy to see on the books where the profit and the loss is coming from. Store Capital is exactly the same. It just has a few clients which may or may not have been able to make it through the pandemic. That's what we thought at first, but what's actually happened is that 98% of Store Capital's clients have made it through the pandemic, and Store Capital have now made it clear that they did not agree to wipe off any rents for these companies. They did defer some of the rents for some of those companies, but now those companies are in better shape, they are able to pay them. For me, this is a huge step in the right direction for Store Capital. The market isn't showing that right now, but the management are very positive, as they probably would be, that rents are still going to come in and any that was lost during the pandemic are going to be repaid now. I really like this, and I've been neglecting my dividend income recently. I've been buying a lot of companies that don't pay that much of a dividend in the favor of growth. Store Capital has a 5% plus dividend. It'd be nice to see that start to come in. 4.2 shares today. I tell you what, let's add on one more just for the fun of it. While there are obvious differences in the two companies, Realty Income is still in a good position like Store Capital. I haven't added a lot to Realty Income, even though I really wanted to over the past couple of years. Realty Income is a very high quality REIT and the market knows it. There are very few occasions over the years where you're going to catch Realty Income at a really discounted price. The last time was March 2020. Right now, Realty Income is neither a great price or a bad price. We can say rising interest rates are coming and therefore interest payments are going to go up, which is going to stifle their margins a little bit, but they have a lot of pricing power within that. They have a lot of companies on really long contracts, so they're able to mitigate for that inflation. Traditionally, REITs do pretty well in recessions. And while I do try to lean towards valuation where I can, ultimately I shouldn't time the market, and therefore I need to give Realty Income some long overdue money. KLA Corp, like a lot of the market, has dropped price in the last 3 months. This for me is my favorite investment outside of ASML on the pure semiconductor usage that we're going to need in the future. KLA is a very quiet company which no one really looks at, but historically it beats the market. I don't see any hype YouTubers banging on about this boring stock. But it's beat the market for 20 years and that trend is set to continue. The reason why no one looks at this stock is because it generally trades at a 15 PE ratio and just grows. Valuation recently has become a bit overblown, but even if it does drop in multiple a little bit, we still have a total annual return of 6.36%. But KLA is growing a little bit faster now in an industry which is really growing. It is becoming a little bit more popular. It's inside the new TSMC sites. It's inside the new Intel sites in Arizona. There is a lot of demand business to business for this product. This is why KLA has a very high percentage in my portfolio of 6%. By the way, this is my pie. You can see all the contents of my pie. There's a link in the description below. If you click that link, you can see all the holdings within this pie and how much I weight them. They aren't necessarily the right weight because some stocks have just gone way overblown and some are falling quite far behind. But please do not follow or copy this pie blindly. Please be very interested in the companies that are in here. And remember, if you invest in some of these companies right now, they may or may not be under or overvalued, and we cannot possibly know what they're going to do within the market. But KLA today deserves another 500 quid. That is only 1.5 shares, which... That's painful. Very, very small dividend yield of 1.18%. I think that's not entirely accurate here on Trading 212 right now, but the dividend yield is still very, very small. And finally, I want to start weighting some of my investments back to what I'd expect them to be. Walt Disney right now should be 4% of my income pie, currently sitting at 2.8% of my income pie, so I really need to get that up a little bit. Walt Disney right now is severely overvalued if you rate it simply off what's been going on in COVID. But analysts are now estimating that in 2023, the dividend payment may come back at around a 16% payout ratio. With the help of Disney's streaming service and the parks reopening, and it looks like the parks are going to open with a massive bang, Disney is probably going to start trading back at that 21 premium again. It might take a few years, it might take a bit of pain, but now that the price has come off, and I expect the price to be between $170 and $200, that's what I think Disney is worth if it's working completely normally. With Disney down right now at $138, I think I should be putting some money in. I see no changes in Microsoft recently, so another 250 quid goes into Microsoft, and I've got £262.90 left, and I think the rest of that is going to go into JP Morgan. Remember, I'm not thinking about this too hard. Over-analyzing everything can be just a little bit too heavy. This can lead to over-analyzing and being completely paralyzed to make any decision. JP Morgan's currently sitting at a price to book value of around 1.4. Its average is around 1.3 usually. It's got a lot of cash on hand, and I don't want to think about it within the macroeconomic environment. No one can tell you exactly what raised base rates are going to do to JP Morgan. When I'm looking at economic problems like raised interest rates, I'm thinking about them personally. I'm thinking about how they will affect my own personal wealth and my own personal spending. As far as businesses go, I think the whole point is just buy great businesses that are going to weather any storm, and JP Morgan's probably one of them. So there we go, the end of the ISA year. I've completely filled my ISA and I'm so happy about it. My portfolio now sits at 47,203. Tune in hopefully next week where I'll take you through my dividend income, because that's not been going up very much.